This component we do every month, which is a market recap, which is really just us taking a hindsight view of what just happened, sort of coupled with some of the noise that we're seeing in the current marketplace. So there's been a lot of activity this third quarter, and that was not unexpected. But what I wanted to tell everybody on this call is that the sky is not falling. As a matter of fact, the markets have rebounded today. What we are seeing is a lot of volatility. What we're also starting to see come to fruition is something that I have been cautioning against for years now, and that is inflation, the I word, right? But it's not going to happen overnight. You'll have, regardless of what side of the aisle you're on, you have some people that'll say, oh, it's just transitory. Other people say it could be long term. Who knows? All I know is that things will be more expensive in the future, and we have to budget for that. Most good planners will build in some type of inflation rate. So even though there might be some spikes, it is nothing really, I think, to panic over, and we can go forward. So without further ado, we're going to look at the equity markets first on a monthly snapshot. So for September, as we look at this chart, the black line in the middle means that anything above it, we had a positive return. As you can see, everything was down for the month of September, right? Except for the commodities, right? And we've all started to hear, and you probably know firsthand that you're seeing prices at the gas pump go up. What I found interesting is I went to Wawa on Wednesday, and I put plus in, it was $3.67 a gallon. By Thursday, I had to go back, and it was up to $3.77. They do not waste any time putting those prices up. So, just understand oil, natural gas, any commodities, copper, steel, any of those things are actually had a positive month. Everything else, it doesn't really matter what you call them, but, 1 month does not a market make. So if we look at how's the year doing overall, we're actually having a pretty decent year, right? So this is why advice has been, we don't want to be completely out of the market, but we have to be concerned on a go-forward basis now, right? We have to have some strategies in place that will prevent a correction like we saw in 2008 or 2000, in the internet bubble burst. So you can see again, commodities, they're all the tear right now. So if you're in the oils, right, I don't know, how long ago it was, but $80 a barrel for crude. If last year, commodities got crushed, this is the place to be if you're a day trader. The black lines, right, is the real estate. So that's the other thing that is people are sort of seeking ownership. But I caution last year, again, it got hurt. And real estate, if you're buying REITs, which are sort of like real estate investments inside of like sort of a mutual fund wrapper, they're called real estate investment trusts. Just be careful, because I've seen a lot of clients come to our office that get into these things, not really certain how they work, and they're not liquid. They really have a hard time getting out of them, right? So your money's tied up. So, hey, everybody wants to get a great rate of return, and everybody thinks that they want to be a realtor or a landlord. But, I see the people, once they understand how it actually works, not always, but hey, the returns here, you can't dismiss. Having some portion in a portfolio and some type of real estate investment, maybe a mortgage-backed securities, anything like that might not be a bad idea. And then the S&P, you can see red. It's up for the year, right? That's the U.S. blue chips, right? And then right below it are small caps, right? The blues. I caution here because, all the pundits, all the news on several different channels caution that small business owners, if some things continue the way that they're projected, are going to get smoked. And they've already come off of COVID, B, just so imagine you're a business and your entire livelihood is dependent upon some type of transitory foot traffic, somebody coming in and out of your store, and people weren't allowed to come in, and now they are, but you could only have 50% capacity, and now they're opening it up, but now they're, it's on and on, and now things are costing more, and now we have bottlenecks at our ports, right? We just have a plethora of hurdles that seem to be approaching, and in most of the big companies, although nobody wants to lose money, they could probably weather the storms. The small guys, they're going to get hurt. So not only can they not find good help to come help them run their business, but now pressure is being put on them. I mean, how do you, if your gas, you're shipping natural gas, let's say you're a restaurant, you use natural gas or even electricity, and prices are spiking. You have a fixed cost to make a pizza or a sub or some type of sandwich or whatever your commodity or your trade good is, that you have some fixed costs that it's very hard to pass on to a consumer in any type of profitable way. So I just caution, look closely at your portfolios as to what you're actually in. And then you got your greens, you got your developed countries over in Europe, right? So everybody's done well. The only two that didn't do well so far this year is emerging markets, which is China. China's getting crushed because, they are out of coal, right? So they are having rolling blackouts for electricity. They cannot produce electricity. So a lot of our goods rely on China. That's just a whole nother series of issues, right? So there's things that are changing in this world. But when we look from an investment standpoint, remember that a reasonable approach to a portfolio, at least when we're doing planning for our clients, if we can get 6% net of fees on average long term, that averages are not every year is going to be 6%. But, I don't need to swing for the fences, but we do want to capitalize when they're there. So we do think that the equities and continuing to be in equities diversified makes sense. But, some of these international funds that get touted, again, I'm not saying that there aren't profitable ones out there, but be careful where they're actually, what countries they're investing in. And then, gold, which is, always a safe haven. But if inflation continues to spike its head, you could see it make another run like it did last year. So this is what we call, the three wise men, or, it's our sort of, it's a simple indicator that has, three triggers, right? The top chart here, the middle chart, and then the bottom chart. You have the relative strength index, right? We have a moving average, and then our MACD, right? And then if you look over to the left, this is 2000. This is a red line. And typically, if all three triggers trigger a red line, all three have to trip, right? It means that the crossover here and the crossover here all happen, means that we're projected to have a downward trend. But if we look here to the left, right, we're still green. We are still on an upward trend, right? How much longer? I don't know. I don't have a crystal ball, but a lot of pundits, I was listening to our CIO or chief investment officer, and he was saying that, hey, the fourth quarter and looking forward, still looks healthy, right? However, what he did caution about was the bond market, right? So we're going to look at that now. Do you notice anything here in September? So imagine you're on a fixed income portfolio. You're counting on income coming from bonds because that was the strategy that you took out in 2010, and everything lost money. It means your accounts are now worth less. Therefore, you're having to take out less in order not to deplete or cannibalize your holdings. But again, 1 month does not a market make. So let's look at what's actually doing well. Not much, right? The two things that are doing well are high yield. High yield munis and high yield corporates, right, are another word. When I use high yield, when you hear on the Talking Heads, CNBC, junk bonds. So that just means that we're typically taking above average risk in order to get some type of return, right? And right now, I think there are other strategies that we've talked about where you can diversify your portfolio, have what we call bond alternatives in place. that you don't need to take this kind of risk. But the rest of it, everything, whether it's, U.S. aggregate bond, high yield corporates are above, but you got 7-day treasuries, you got 20-year treasuries. These were all the raves. Safe money was going here last year. And then you had the total international bonds, again, that's overseas. So they're getting crushed. And then, you have normal bonds, right? And then you have the high yield bonds, right? So all these bonds in general have continued to make me nervous. And I'm just advising clients, and most of the advisors that I deal with and work with across the country have been cautioning. But yet I can't tell you how many times I'll see a portfolio where somebody will hand me their 401k statement and said, hey, this is what they said to do, 60-40, 70-30. I just saw an article, I think it came from Forbes, where it said the 60-40 model is dead, right? And I don't necessarily disagree. I'm not saying that bonds don't have a place, but to set it and forget it with bonds in your portfolio, I think is a recipe for disaster, because the bond portfolios are going to continue to have a hard time in a rising interest rate environment. Remember, they're inverse relationships. So as interest rates go up, which happens when inflation goes up, so these things are all correlated, right? So as we start to see things get more expensive, right, then you'll see that the banks will start to lend money at a little bit more money. And as interest rates go up, you'll see the underlying value of the bond go down. So your portfolio, although the interest rates are going up and you're going, I should be making money, the underlying security is at risk. So right now we still have a green line, this one all the way to the right. But there is cause here. We are watching closely. I've been talking about this for a couple months now. It's been close a couple times. Again, the sky's not falling. The reason I like to do this, I think it does allow us to sort of take what happened last month, where we had a lot of volatility, a lot of news in the marketplace, things are happening. We still have a lot of news in the marketplace almost on a daily basis, almost to the point where it's just, I have to turn off the TV and the news myself because it just gets, upsetting. Right. So when you see this and you go, how can these decisions be being made by our elected politicians? It's just beyond me. But that being said, we do have a proprietary indicator. It's called the recession probability analytics. It's actually down. Right. So we're below the black line, which is the 50% threshold. And when you're below the 50% threshold, it doesn't seem like anything is looming, which causes us grave concern. So in summary and in ending, this is overall is good news, right? So, here's our disclosures, right? That I didn't make up the S&P or any of the indexes or terms that I use. And this is not to be misconstrued as investment advice, just education.